In this video, we are going to talk about the 5 best places to invest your money. So before starting, please like this video and subscribe to this channel for future updates. Let's start. Number 5. Corporate bonds. Corporate bonds work similarly to government bonds, only you're lending money to a firm rather than the government. As a result, these loans are not government-backed, making them a riskier alternative. And if it's a high-yield bond, also known as a trash bond, it may be far riskier, with a risk/return profile that more closely matches stocks than bonds. Investors searching for a fixed-income instrument with a greater prospective yield than government bonds and are ready to take on a little more risk in exchange. The larger the risk of a corporation going out of business, the higher the yield on corporate bonds. Bonds issued by big, reliable firms, on the other hand, often have a lower yield. It's up to the investor to discover the right risk-reward ratio for them. Number 4. Government bonds. A government bond is a loan from you to a government body, such as the federal or local government, that pays interest to investors over a predetermined period of time, usually 1 to 30 years. Bonds are classified as fixed-income assets because they provide a consistent source of payments. Government bonds are nearly risk-free investments since they are guaranteed by the United States government's full faith and credit. What are the disadvantages? Government bonds, in exchange for their safety, do not provide as high a return as other forms of investments. It would be far more difficult to meet your retirement or long-term objectives if your portfolio consisted entirely of bonds, rather than a mix of stocks and bonds. Bonds are popular among investors approaching or in retirement because of their stable income and decreased volatility, since these people may not have a long enough investment horizon to withstand unexpected or severe market drops. Number 3. Money market funds. Money market mutual funds are not to be confused with money market accounts, which are bank deposit accounts that resemble savings accounts. Your money buys a collection of high-quality, short-term government, bank, or corporate debt when you invest in a money market fund. The money you'll need in the near future and are ready to risk a bit greater market risk. Money market funds are also used by investors to store a part of their portfolio in a safer investment than equities or to hold money set aside for future investment. Money market funds are technically an investment but don't anticipate the same high returns or risk as the other products on this page. Money market fund returns are more equivalent to those of high-yield savings accounts. Number 2. Certificates of deposit. A CD is federally insured savings account with a fixed rate of interest for a certain period of time. A CD is best for the money you know you'll need at a certain time in the future, e.g., a home down payment or a wedding. CDs come in a variety of term lengths, including 1, 3, and 5 years, so if you're looking to build your money for a particular purpose over a certain period of time, CDs might be a good fit. It's worth noting, though, that you'll almost certainly have to pay a charge to get your money out of a CD early. Don't purchase a CD with money you'll need soon, just like you wouldn't buy other sorts of investments. Number 1. High-yield savings accounts. In comparison to a regular bank savings or checking account, online savings and cash management accounts provide better rates of return. Cash management accounts are a cross between a savings and a checking account. They may pay comparable interest rates as savings accounts, but they are usually provided by brokerage companies and may include debit cards or checks. Savings accounts are great for short-term savings or money you only need access to once in a while, such as an emergency fund or a vacation fund. A savings account can only make 6 transactions each month. Cash management accounts provide greater flexibility and, in some situations, better interest rates than traditional savings accounts. If you're new to saving and investing, a decent rule of thumb is to maintain 3 to 6 months' worth of living costs in an account like this before investing more in the goods farther down this list. Where to create a savings account? Online banks often provide greater rates than conventional banks with physical locations due to fewer overhead expenses. To locate a high-yield savings account that meets your requirements, go through our list of the finest high-yield savings accounts. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.